Hello, I'm Bill Wilt, and welcome to the March 2026 edition of the Assured Briefing. In the next few minutes, I'll walk you through the main themes from this month's research. We'll first focus on personal auto physical damage, next intrinsic value and buybacks, and third workers' compensation. Then I'm going to briefly touch on the legal system abuse, cat bonds, and FEMA's new National Risk Index. Let's start with personal auto. Results in 2025 were very strong, but part of that performance likely came from changes in policyholder behavior. Rising premiums and affordability concerns led many consumers to raise deductibles, drop physical damage coverage, and/or avoid filing smaller claims. That created a behavioral tailwind for property casualty auto insurers. But looking ahead, there are three key points from a detailed analysis we did that married decades of auto physical damage claims with registered motor vehicles and some kind of macro data. First, claims tend to rise when the economy improves. No great insight there, but there's support to say that economic activity usually means more driving, more people out and about, and more reported claims. But second, and more nuanced, the auto pricing cycle matters. When rates rise sharply, the data suggests that claims in the next year are fewer than what would otherwise be predicted. And that suggests that consumers or aligns with the idea that consumers become more cautious about reporting claims and or simply don't, in the period when rates were rising, may have simply dropped certain types of physical damage coverages. And third, looking ahead to 2026, if and as we expect the auto market continues to soften, that claim tailwind may reverse and become a headwind. Better economic conditions, more stable pricing, and certainly the ubiquity of auto insurance commercials could lead to more people adding coverages, people being less concerned about having their insurance costs rise if they report a claim, more confidence that they can find another carrier if they are dropped by their current carrier, and certainly if the economy improves, that would suggest people would be adding back those coverages and have more confidence to report claims. So, bottom line is strong results in 2025. We think we're helped by claiming behavior that may not repeat in 2026. More in the note, of course. Next, let's turn to capital management and intrinsic value. Historically, property casualty insurers have returned about 80% of operating earnings back to shareholders, with more than half of that coming through buybacks. The key question is whether those buybacks are done above or below intrinsic value, and the central question are can management add value or subtract from value depending on the price at which they repurchase shares? And the answer is, of course, but it can be, we refer to it in the note as the dark art of determining intrinsic value. It's a very, can be a tricky concept, but we try to boil it down in this note. First, the market implied cost of equity for insurers. We looked at a cohort of 30 insurers over a couple of decades or more. The market implied cost of equity appears to be around 8%. And frankly, most studies and fairness opinions that we observed point to a range of 8 to 11%. We probably shade the lower end of that a bit higher, closer to 9% plus, but either way, in that range for the cost of equity. But second, the cost of equity, as we show in the note, does vary by sector. Reinsurers are at the higher end of that range. Personal and specialty insurers at the lower end of that range, commercial insurers kind of really around 8%, not quite in the middle of the range, but standard commercial insurers in the middle when compared to the other sectors of property casualty insurance. Now, third, buybacks create value when intrinsic value exceeds market value. And that happens when management believes its long-term or long-run ROE is higher than the return implied by the stock's price. There's a bit of math involved that's shown in the note, but once a company decides on its own cost of equity, using some financial math, and algebra, it can fairly easily discern the ROE embedded in its stock's valuation. And then Once you have that, you can decide whether the management team can decide whether their view of ROE is higher than that which is embedded in the stock's price. If it's higher, exceeded value exceeds intrinsic value exceeds market value, and buybacks make sense. If it's lower, the opposite would be true. On to workers' compensation. Now, claims are as we've shown in past briefings using work by the WCRI, for instance, claims are heavily concentrated among newer employees. About half of claims occur within the first 2 years, and with a substantial portion of those occurring in the first year of an employee's tenure. So that makes hiring trends especially important. And we have three key takeaways as we look at the labor market. Um, First, across nearly all industries, faster hiring leads to more claims. We have, I think it's 21 years of claim data from the federal government, which we're able to get by industry. So we look at the combination of claims for illnesses and injuries per employee by industry and growth rates over time by industry, and lots of support that incidence rates rise when employee growth accelerates. The exception to that general rule pardon me, is found in healthcare, where more workers and faster hiring actually leads to fewer claims. But generally, when hiring accelerates, claims accelerate. When hiring slows and tenures rise, claim frequency tends to fall. So that makes the outlook for 2026 heavily dependent on the labor market. Weak job growth, which is kind of what we think is more likely than not, would reduce claims, but it would also slow premium growth. And of course, the reverse is true with stronger hiring um, would would lead to more premiums and also more claims. The exception to that, or the asterisk, being that healthcare is an exception. It's been a major source of employment growth here in early 2026, and faster hiring in healthcare doesn't appear to lead to more claims. Some quick hits for you. A note on legal system abuse. We're trying to find a macro leading indicators of legal system abuse using our residual trend metric that we have over, I think it's 40 years. We looked at a number, but none were really strong, with the exception of as to a modest positive correlation of real wage growth. When real wage growth was rising, we did see some limited correlation with liability loss trends, the residual trend, but we don't want to overstate that. The main takeaway now is that social inflation, continues to be kind of elusive and difficult to predict with macro data. Onto cat bonds, property cat bonds, spreads in with bonds priced in the first very early weeks of 2026 into kind of mid-ish February with our data. Spreads on cat bonds are really coming down, and we show a strong historical relationship when lagged by 1 year between cat bond spreads in, say, year T, the current year, and the Guy Carpenter rate on line change in the year following. So the takeaway would be that if we think if during the first half of 2026, if cat bond spreads stay as low as they are, and they are back to levels that haven't been seen since the mid 20 teens, that could portend another meaningful decline in property cat rates, traditional property cat rates at mid-year renewals. We're going to end with a comment on FEMA. And the National Risk Index, which some of regular readers will know we started looking at about 3 years ago now. We didn't think that the National Risk Index would be updated, but it was, and that is great. So we study the current version of the National Risk Index, released in December of 25, to the March 2023 prior NRI index, looking at losses to buildings by peril, by region, and kind of summing it all up. What we can tell you is that the biggest change by far was a meaningful increase in the expected losses to be caused by inland flood. Most of the other perils, and there are 18 of them, didn't change by a lot. but certainly even those that did change notably, that pales in comparison to the change in inland flooding. So folks may want to dig into that and learn more. So summing up, personal auto results may lose a behavioral tailwind in 2026. Intrinsic value should guide buyback decisions, with the math indicating that intrinsic value will exceed market value when management's view of the long-term ROE is higher than what's embedded in the stock's price. Workers' comp claims are tied to the hiring cycles. Notably, healthcare is an exception. Social inflation remains difficult to forecast. Cat bond spreads point to lower property cat rates at June and July renewals, and FEMA's updated National Risk Index points to a much higher inland flood risk than what was previously considered. Listen, we appreciate your attention, appreciate your interest in our work, and please reach out if we can be helpful in understanding any of this. Thanks again, and have a great rest of your day.